climbing higher and higher. Yesterday, the all-time high, the intraday high was 18,614. We opened slightly below that level, but now look at the way the markets have picked up. 2 hours gone since the markets have opened up for trade, and we've only gone from strength to strength, up 0.5% on the benchmark indices, but the mid-caps are trailing a tad bit. Nilesh Shetty, the portfolio manager at Quantum Advisors, is now joining in to talk about the way forward. Nilesh, that's the question, right? We've got here, we've done absolute outperformance, relative outperformance. What are the triggers for the markets for a further rally from here on? That's point number one. And secondly, we had Rahul Arora of Nirmal Bang earlier today join us on the channel, and he was telling us a lot of fund managers are asking him, what should we sell right now? So they're not convinced about the markets going up from here. Are you also hearing that kind of questions?
No, I mean, for us, we actually remain fairly optimistic. I think in a world which is staring at recession, India will stand out. I think a lot of money will come into India. And it's typically in an economic expansion where analysts are playing catch-up to earnings. We've seen last 2 years our analysts were surprised on the upside to the earnings that was delivered. And we think that trend will continue over the next 2-3 years. I think India is in an economic expansion after almost 7 years of downturn from 2013 to 2020. Economic growth continued to surprise on the downside. Perhaps it got elongated because of demonetization, GST, and then COVID, the down cycle. But after that, it looks like a bottom was found somewhere around COVID, and the economic up cycle started. And private capex has not even kicked off. So I think with the next 12, if the demand remains strong, you will see private sector announcing new capex and infrastructure projects, which will again create another wave of economic demand. So again, we remain very bullish. We think there is further upside to the market. I think India will stand out and will attract a lot more higher flows. And it's not the time to reduce allocation to equities or reduce exposure to India.
All right. It's not the time to reduce the exposure to India. But at some point, things will turn, right? We are seeing a fair amount of outperformance from Hang Seng in the last couple of days after the underperformance that we saw. So do you think incremental flows which came into India as a result of them moving out of, say, China as well as Hong Kong, etc., will now reverse? Is there a possibility, or the money that stays in India, and any other money that comes in will incrementally go to these other places?
Unfortunately, flows did not come to India. This year, still, we are about $18 billion in negative. So what happened was a negative drag that China created in the EM indexes created a sort of backlash against emerging markets, and a lot of fund managers sold out of emerging market indices, which created outflows from India as well. But at least when we interact with a lot of foreign investors, some of our own clients, India is in the top of the mind. A lot of them are wary about China. So you could have tactical trades where people might allocate to China because it has fallen a lot more. But if you're a long-term strategic investor, if you're looking to allocate for the next 5-10 years, I think India is at the top of the mind in terms of one of the top emerging markets that we would want to invest in.
All right, Nilesh, good morning and thanks for joining us. You said that the up move is likely to continue. India is likely to, keep doing better than the rest of the world. What do you think are the sectors or the spaces that are really going to drive this up move? So far, we've seen the financials do very well. The auto pack has done well. Do you think that's a trend that will continue?
Yeah, so I mean, the last decade was clearly a decade for growth stocks, right? So in a low GDP growth environment, companies that were offering slightly higher growth got re-rated quite dramatically compared to the sort of broader economy or stocks linked to the broader economy. Once the economic expansion started, the growth differential narrowed. And in fact, there is now a big question mark on the growth stocks, saying why should they trade at the multiples that they're trading at when the other sectors are doing equally well. So I expect sectors linked to the broad-based economic recovery to do a lot better, including consumer discretionary, two-wheelers, financials. I think they would perhaps lead the next wave of the rally. And some of them have still not moved. Financials have actually underperformed post in the COVID rally. And there is, at least our sense is, there are opportunities emerging there. Was a disappointment of some of the sectors that were re-rated. So we have opportunities emerging in asset management, in insurance. These were sectors which were priced for growth, but the underlying earnings delivery was not there. So that has now created a lot of disappointment, and valuations have come off quite dramatically. So we found stocks in these buckets to add to the portfolio.
You've also started recently increasing your weight in technology, and this is after trimming it through the whole of last year. Could you tell us the reason why?
Again, we are sort of value investors, and given the deep correction that has happened this year, the top names are down anywhere between 25 to 30%, and then the sort of tier 2 names are down 40 to 50%. Now, we think demand will slow down. There would be some impact of demand on these companies. But if you're looking with the next 4-5 year view, the valuations at which they're trading, they look fairly attractive investment opportunities right now. I think if you sort of take away the noise that is around US recession and you look at the hard data and the numbers that these companies are reporting, it's not that bad. It's actually been quite good for these companies. None of the commentary so far has sort of suggested a sharp slowdown. There is some noise about clients rethinking budgets, but as of now, you've not seen any major cuts in budgets. So given the deep correction, we think these companies offer great investment opportunities right now. So we started increasing our weights gradually in the sector.
All right. And your exits are rather interesting because you've exited cement companies and a hospitality name. We can probably assume, guess which hospitality name it would be given the sort of price correction that we've seen in a couple of these stocks. But everyone's hoping for cement to recover just ahead of budget. Everyone talks about this big infra push coming in. At the same time, from a long-term standpoint, mid to long-term standpoint, the hospitality segment in India has, demand-supply dynamics in their favor. So to that extent, what explains this exit? Is it just a near-term exit and then you'll look at better entry levels, or maybe you think everything has been priced in and you just exited because it was all priced in?
Yeah, like you said, when we did the numbers, our sense was what was being priced into the stock was much ahead of underlying fundamentals. When you benchmark these companies on earnings or replacement, they started trading at substantial premium to that. That is what triggered our exit. Even in cement, when we looked at valuations for our holding companies, again, the companies were re-rated because of change of management, but underlying fundamentals have not changed. So for them to trade at twice replacement costs, so even at replacement to make 15% ROEs was a struggle. So at that kind of valuations, even though we have no doubt that the demand will recover and companies' profits will grow, but how much of that was priced in our sense was most of the good news was already in the price, which triggered an exit from our portfolio.
Okay, sorry. Nilesh, we'll leave it to that. Thank